China has just shaken the global economy to its core. It has frozen all investments in American companies, instantly wiping out a staggering $1 trillion. This isn't just another policy shift, it's a bold declaration: enough is enough. After years of tariffs, tech bans, and investor pressure, Beijing is responding on its own terms. Wall Street is in turmoil, markets are crashing, and everyday Americans are footing the bill, now paying an extra $1,000 a year for basic goods. But here's the twist: China isn't backing down. It's changing course, redirecting its capital to Asia, Europe, and even to US allies like Saudi Arabia. It's building a new financial system in which America is no longer the central pillar. So what's really happening? Is this revenge, economic pressure, or the beginning of a global power shift? Let's break down China's strategy, its consequences for global markets, and ask, can the US recover from a blow it essentially brought upon itself? So hit the like button, subscribe, and let's dive into this $1 trillion storm. Imagine this: you wake up, turn on the news, and hear that $1 trillion has just vanished from the US economy. Just gone. No warning, no explanation, like it evaporated. That's exactly what happened when China suddenly halted all investment into American companies. It wasn't an accident. It was a calculated move that could reshape global capital flows. It all began quietly. On March 17, 2025, China's foreign exchange regulator SAFE issued a secret directive: no more investments in the United States. That same day, the Ministry of Commerce updated internal guidelines, labeling the US a hostile investment destination and halting all non-essential capital flows. No press release, just leaked documents later confirmed by Reuters. Overnight, Chinese money that used to flow into Hollywood, tech startups, and big-name firms stopped completely. Done. Zero. That's a massive blow. In 2018, China invested $46 billion in the US. By 2023, that dropped to just $2 billion, according to the Rhodium Group. And now, it's nothing. A negative trillion. Sounds shocking, but that number reflects the total scale of Chinese investments, bonds, real estate, equity, that are no longer backing American markets. Professor Kai Daozhang from Peking University called it a financial knockout, a smart way to damage the US without open confrontation. This isn't an emotional decision. It's cold, strategic pressure on America's biggest vulnerability: its dependence on foreign capital. Many still think of the US as an economic superpower, but few realize how deeply it relies on external funding. The America First policy championed by the Trump administration, with its tariffs and restrictions, may sound patriotic, but it ignores a harsh truth. The US economy runs on global money, and isolation could lead to collapse. And the data backs this up. In 2023, the US attracted $311 billion in foreign direct investment, according to Visual Capitalist. That money goes into factories, startups, real estate. It creates jobs and drives growth. But it's not just about direct investment. Since 1991, foreign investors have poured $128 trillion into US assets such as stocks and bonds, according to Bank of America. This flow keeps markets afloat and helps fund America's enormous national debt. By 2025, US net external liabilities exceeded 100% of GDP, showing just how much America depends on foreign money. Without it, borrowing costs would soar and businesses would struggle to access capital. Foreign direct investment into the US fell by 34%, from $88.5 billion in fourth quarter of 2024 to $59 billion in first quarter of 2025, according to the Bureau of Economic Analysis. Stock investments plunged by 62.5%. Why? Because uncertainty over tariffs and regulatory risks is driving investors away. Trump's team claims this is all about bringing manufacturing back home, but economists like Paul Ashford from Capital Economics warn that such instability is paralyzing investment decisions and stalling growth. The myth that the US can simply detach itself from the world overlooks how deeply interconnected the global economy really is. For example, BMW builds more than half of the cars it sells in the US, right inside the country. Yet Peter Navarro, Trump's former trade advisor, called such investments a scam, forcing other Republicans to step in and defend BMW once they realize just how crucial foreign capital is to American industry. Meanwhile, the US is debating a new 20% tax on foreign corporate income. Experts at the Tax Foundation say this could drive even more investors away. Turning away global capital in favor of political slogans risks tanking markets, driving up prices, and slowing innovation. By 2026, the US will need to refinance $4 trillion in corporate debt, and without foreign buyers, that could become nearly impossible. The American economy runs on global investment. Cut off the flow, and the system could quietly collapse. The US and China have been clashing for years over trade, technology, and more. The US imposes tariffs on Chinese goods, bans chip exports, and in January 2025, it restricted investments in Chinese tech firms. Now China is responding by pulling its money out, and it knows the US cannot survive without that capital. China isn't just sitting on cash, it's actively redeploying it elsewhere. In 2024, Beijing sold $57 billion in US Treasury bonds, bringing its total holdings down to $756 billion, the lowest level since 2009 and the biggest sell-off since 2016. Chinese banks, under orders from the People's Bank of China, have started shutting down dollar-based transactions with American banks. So where is all that money going? Anywhere but the US. According to leaked HSBC reports, China is pouring billions into government debt across Southeast Asia, countries like Vietnam and Indonesia. Even Saudi Arabia, a US ally, is shifting course, putting $50 billion into a tech fund co-managed with China and Singapore. Back in the US, panic is setting in. As soon as the news hit the headlines, the stock market took a nosedive. Over the past 3 months, investors have pulled $120 billion out of US funds, according to Bloomberg. Small and mid-sized companies are suffering the most. China has already left, and now others are following. Norway's sovereign wealth fund withdrew $1 billion from American tech companies, citing regulatory unpredictability. Japan's largest pension fund slashed its investment in US real estate by 30% after US banks were downgraded. Looming on the horizon, $4 trillion in corporate debt. And with foreign interest fading, American companies are forced to borrow domestically, which is far more expensive. In 2024 alone, businesses issued $430 billion in junk bonds at an average interest rate of 9.6%. Back in 2022, the average interest rate on corporate bonds was just 5.2%. Now it's 9.6%, a true financial chokehold. Companies are barely surviving, and it's not just businesses that are hurting. The new tariffs, 50% on Chinese goods worth $500 billion, are making everything more expensive. At the start of 2025, appliance prices surged, according to the Bureau of Labor Statistics. Retail giants like Walmart and Target report losses, and the National Retail Federation estimates that the average American family will spend $1,950 more this year on clothing, TVs, and other electronics. Inflation is still above the target level, while wages are not keeping up. As a result, people are spending less, and businesses are taking the hit. By the end of 2024, corporate earnings in the S&P 500 grew by only 1.2%, compared to 4.5% the year before. It's a deadlock. Either businesses lose money, or they raise prices and lose customers. On paper, bringing factories back to the US seems like a logical solution, which is exactly what Trump aimed for with his 2025 executive order, tax breaks for companies building plants in America. But the reality turned out differently. The National Association of Manufacturers is already sounding the alarm. Companies wanting to expand in the US are hitting a major roadblock. They simply cannot secure funding. And with investors like China pulling out, the capital just isn't there. Major projects have stalled. An $8 billion battery plant in Michigan has been frozen, and a $3 billion robotics center in Nevada has been canceled. Chinese and Taiwanese investors who were supposed to fund these efforts have disappeared. Even flagship programs, like the $52 billion CHIPS Act, designed to bring chip manufacturing back to the US, are faltering. Intel's $20 billion plant in Ohio, once hailed as the symbol of America's industrial revival, has been paused due to market instability. While the US is delisting Chinese companies from its stock exchanges, China is doing the opposite, opening up to the world. And if this momentum continues, the United States risks losing more than just capital. It risks losing control. There is almost no time left to sit and debate. Washington must act urgently, restore order, bring back stability, revive critical financial initiatives like the CHIPS Act, lower interest rates, and rebuild the trust of its allies. Otherwise, this $1 trillion shock won't just be a flashy headline. It will go down as a historic turning point.